This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, what a week. What a week indeed. We'll have much to talk about on the program to try and explain something that, at the end of the day, in all honesty, there isn't a perfect or a single explanation on it. Because oftentimes when you have weeks like this in the market, that it's really more of an emotional reaction, right? I mean, that's really what causes these market moves to get a little bit unhinged. The Wall Street Journal, in a headline in the weekend version of the Wall Street Journal, sums it up pretty well. The baffling moves behind stock rout. And certainly there's a lot of speculation as to what caused it or what happened. I think probably the biggest explanation is complacency, meaning that there is a psychological phenomenon known as recency, which means that as human beings, we just think about what has happened in the past, or more specifically, the most recent past, and therein lies part of the problem. And then we believe that that's going to continue on the same. At the end of the day, you know, it's fascinating. You hear some of these products, these new products, and some of these products are actually being blamed for contributing to the decline. Again, not any one thing, but I think a bunch of stuff all kind of came together. Low volatility ETFs and the like were becoming the rage, if you will. And lo and behold, when volatility hits, those funds are ill prepared for being able to deal with it. Obviously, very unique investments, but at the end of the day, if you owned one, you suffered a pretty significant decline. In fact, one of said types of funds actually wound up getting shut down because it was simply based upon the volatility and the volatility going one way, or, well, it was based upon the fact that it was predicated upon no volatility whatsoever. And that, you know, that sort of forgets history, right? I mean, if you look just over the course of the past few years, you will find many occurrences where there have been similar declines, all the while the market was continuing an upward trajectory. And I think that's how we kind of get lost in this thing is you know, we too busy looking at each and every daily move and sort of forget the overall pattern. Think of it like climbing up a mountain, okay? I don't know about you, but I've never seen a mountain that is completely smooth all the way to the peak, right? Doesn't exist. It's rocky. There's parts that are steeper than others. There's parts where the footing is a little slippery. If you are looking at your feet the entire time, you will miss the grandeur of the mountain. And the reality is the market is a bit like that mountain now, isn't it? Particularly if you step back and look at it over the past 80 years. But if you come up close and look at it every step of the way, well, you may need to take a few Rolaids if you're doing that. But maintain some level of perspective. So going back all of 7 years, this now is the fifth occurrence where you have seen the markets go down by 10% or more. Meanwhile, the Dow has gone from a level of 6,700 all the way up to, at close on Friday, 23,860. So that's the mountain, right? Okay, 6,700, which is the low that it hit coming out of 2008 in March of 2009, 6,700 to 23,860, which is where it closed on Friday. So that's the mountain, okay? That's a pretty good size mountain, folks. But if you look at every step and every day along the way, there are certainly periods of time that you're going to get distracted from that mountain. In fact, over the course of the past 7 years, there have been now 5 points in time where the market went down at least 10%. The last time it happened as recently as just 2 years ago. Just 2 years ago, there was almost a 13% slide in the overall market. So again, little perspective goes a long ways. Another factor in this volatility is perhaps simply because last year was a completely calm year. We've talked about that on the radio program before because there really wasn't much. There wasn't any. Prior to about a week and a half ago, the market had gone on for the longest period of time without so much as a 3% decline. So pretty rare that happened. So, if you can say that something being overdue is a reason for something happening, then I guess you can chalk some part of this up to that overdue mentality. Okay. And then there's the whole sort of consolidation and health argument, which is that ultimately it's always good for the markets to sort of consolidate the gains and ultimately experience the kind of volatility because that's what makes the market the market. Okay. So many causes and theories and suggestions on it. The other one that's floating around, and each one of them, don't get me wrong, each one of them have some basis of truth or evidence behind them that supports the argument. The other one is just the what I refer to as the what ifs. Okay, concern over the what ifs. Well, what if, okay, because remember, all of this started a week ago Friday when the economic data came out that said that wages had gone up by 3%. That's a good thing when you stop and think about, well, wait a minute, if people are getting more money, that means that if the wages are going up, that means people are going to get more money. But then it became a series of the what ifs. Well, what if that wage increase puts inflationary pressure in to the economy? And then what if that inflationary pressure is so much that the Federal Reserve has to raise rates? And what if the Federal Reserve, if they have to raise rates, what if they do that too quickly? What if that happens? Then you might wind up disturbing the fundamental economy. That's the what ifs. So see that series of events that have to happen. What if? And sometimes if you spin those what ifs out too deeply, then guess what? You wind up getting a overreaction in the market. We've got much more to talk about on this topic. We also want to recap some of the information that was shared with our clients this past week. We had one of our quarterly client get-togethers where we bring in a speaker from the industry to talk a little bit about what's going on in the economy and the market. So obviously that was pretty timely. So we want to share some of the perspective on that as well. So we'll do that when we get back. This is, of course, Dollars and Cents. This is Joel Garris here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome to the program. Welcome back. Welcome back. Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA. And, of course, for our good friends over on the AM dial. That's 540 AM. Of course, since we are, in fact, a financial planning-oriented show, we would be somewhat remiss if we weren't talking a bit about the markets on the program today. So obviously, we are engaging in that. Some additional commentary on it. There is some... another reason, we're kind of going through the litany of reasons that are floating around out there to explain what happened this week. Bottom line is that the market has volatility, period, end of story. If you look at the history of the market, you will find that volatility is a very normal part of the market. On average, about 3 times during any calendar year, you'll see about a 5% decline occur 3 times per calendar year. 10% decline is usually about every year or so, maybe every couple of years, and a 15 or 20% decline usually is a bit more spread out than that. So all of this is somewhat normal behavior. A lot of what-ifs are concerning the overall markets, combined with the fact that I think, once again, you hear the old excuse, if you will, going back to the excuse you heard all the way back in 1987, that a lot of the computer algorithms were taken over, particularly in the last couple of hours of the trading days, and ultimately accelerating the declines in the market, particularly on Monday and Thursday. I think there is probably some truth to that as well, particularly if you look at the 30 trillion that left the equity side during the course of last week. Obviously, that's going to accelerate. And that is, I guess, our chief concern for our listeners who own index funds and ETFs that blindly sort of track the overall market. Generally, and we had an opportunity to join Michael Yaffe's show on Wednesday to talk a little bit about this, but generally, if you're doing it yourself, right, then you don't have anybody that you can call that says, hey, I know you. We've got a long relationship. We've known each other over the years. We've seen this before. And your best course of action is to leave it alone. But if you're calling a 1-800 number, if you're going online, you're probably not going to get that message. Now, granted, a lot of places on their websites did have little pop-ups that said, there's an extreme level of volatility happening in the market. And, history or studies say that it's best to leave your investments alone during periods of time like this. And that's all fine and dandy if a pop-up blocker, a little pop-up screen will convince you of that. Well, then that's great. It seems to me if you're in a more emotional state that's probably not going to work. And so consequently, if you're dialing an 800 number or logging in, I think it's hard to get some balance in those emotions. That's why not only did we have a big client meeting on Tuesday, which was already on the calendar, of course, because it takes some time to plan those. So but certainly the timing was good. We also reached out to all of our clients on Thursday in an email that we had put together that helped to bring some perspective, and in particular highlighted the underlying economic data that continues to come out pretty decently. If you look at where corporate earnings are at this point, okay, about 60% of the companies of the S&P 500 have announced their earnings for the last quarter of last year. 77.9% reported earnings that beat expectations. So, 4 out of 5 are doing better than what people thought they were going to do. Earnings are expected to increase 14.3% compared with the same quarter 1 year ago. So earnings are up over 14% from a year ago, and revenues, which of course is the top line number, are up 7.8%, so nearly 8%. Folks, if your earnings are growing at 14% and your top line revenue is growing at 8%, it doesn't sound to me like an economic situation that is in dire shape. So at the end of the day, be very careful with what you do and how you react, because it's times like this that can have a permanent effect on your ability to get long-term investment results. Volatility is normal. If you didn't know that when you opened your investments or invested in the manner that you did, then somebody probably didn't do a good job describing what you were getting into. Because the reality is that there is, of course, an inherent level of volatility in the market. But we will see how the next week goes. This concern over interest rates and what the Federal Reserve is going to do and those kinds of things has actually had a relatively interesting phenomenon, which you don't see very often, is that everything's correlated, meaning that everything is feeling the effects of that. Traditionally, investor portfolios are combinations of stocks and bonds. If you look at most bond funds on a year-to-date basis, they're down about the same as most stock funds. Okay, because I think people forget just how much the market went up in January. Okay, in January, the market was gaining 1,000 points within a matter of days. So yes, a lot of that has shifted off. Interestingly, the markets closed on Friday higher by about 600 points than where they were at Thanksgiving. 600 points higher than where they were at Thanksgiving. If I had said to you on Thanksgiving that over the next couple of months, you're going to make 1.5%, 2%, wouldn't you have been happy with that? But the reality is that we sort of forget and lose perspective very, very quickly. So the markets basically sit about 600 points higher than where they were on Thanksgiving, which was just 2 months ago. But to the year-to-date numbers, Equity funds are down a couple of percent, maybe 3%. But the hard pill to swallow is that the bond funds are also down 1 or 2%. Okay, and that's the piece that has caught, I think, folks' attention. And it's fascinating. You have all this money leaving the equity markets going into the bond side. Well, the performance there isn't any better, because what we're seeing is the very simple principle that exists when you own a bond fund. When interest rates go up, bond prices go down, which means that you're losing money. So bond funds down 1 or 2%, equity funds down 2 or 3%. That's may come as a surprise to folks that own a lot on the bond side, thinking that it was going to be perfectly hunky-dory. It is not when you get concern over interest rates that then start to drive up interest rates, which then push down bond prices. So be careful with that. That's why one of the biggest reasons why, as our traditional investment approach or our traditional investment allocation, we're not big fans of of owning a lot on the bond side. We're much better positioned, in our opinion, to be owning more large blue chip, big giant companies, names that that produce the goods, the products, the services that you and I use, and the rest of the world for that matter, on a daily basis. So for exactly this reason, if you start to get some level of movement on interest rates, your bonds go down. Well, what's the what's the point in owning a bunch of bonds, right? And I understand it brings stability, it brings balance, and not to say that you shouldn't own any, but our contention is that there's a lot more of the investing public that owns a lot more on the bond side than they probably should. They are buried in places where you would least expect. Things like these target date funds, and just in general, the computer allocations that you're told to follow whenever you're logging into an account or on a 401k. The answer is heavier on the bond side, but in our view, that doesn't necessarily work out best over time. So watch that bond allocation. That is for sure. We're going to slide to the break. We get back from the break. We will continue the conversation, probably shift some gears, talk about some tax stuff, because after all, that is starting up straight away. So we will continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on 540 AM News Radio 102.5 WFLA. This is Joel Garris of Nelson Financial Planning, talking a bit, of course, as you might well expect, on the markets. And obviously, the markets showed a lot more volatility this past week. If you missed the first part of the show, no one reason, right? As is always the case, no one reason what's behind all of this. There's a lot of speculation about interest rates. There's a lot of speculation about computer-driven algorithms that produce some selling. And then there is just a lot of speculation over fear, and then a lot of speculation over just simply it hadn't happened in a long time. So you take all of those together, and I guess you've got a full-blown explanation as to what happened in the market. Bottom line is the markets are inherently volatile. That's the way it's always been. That's the way it always will be, because we liken the markets to that mountain. We were talking about that earlier in the show. Think of a mountain, right? You look at a mountain. Is it a nice, smooth, 45-degree angle up to the peak? Of course not. Doesn't exist. But at the end of the day, it's a beautiful peak. Much like the markets in March of 2009 were at 6,700. Now they're at 23,860. That's, you plot that on a spreadsheet, that's a pretty good mountain, right? But just like any mountain, if you look at each step that you've got to take on that mountain, well, some of them are more treacherous than others, right? Some of them have some gravel. Some of them you might lose your footing. Some of them are pretty narrow. The path is pretty narrow. Others, the path is pretty steep. Sometimes you may have to go down before you can go back up. The reality is that if we get too fixated on those individual steps, we'll lose sight of the beautiful mountain around us. Look up, look around, and don't get too distracted by what's going on a daily basis. Remember, your investments are intended to generate results, not just last week, not just this month, frankly, not even just this year. They are intended to generate results over the rest of your lifetime. If you take a look at that from that perspective, if you take a step back and look at the mountain, you'll get some perspective on this. Let's shift gears. Started doing taxes. It started going over some of the tax returns in the office. And there are a couple of scenarios, and this was really kind of the first week where we started sitting with people and reviewing their final tax returns, because obviously we're early in the season. But there are a couple of situations that I want to talk a little bit about right now in the program, because both of them were folks that were able to get much more deductions under the old rules than what's going to happen under the new rules for 2018. So there's really a lot of things that you need to be looking at when you complete your 2017 return, because you really want to be thinking about, okay, well, what's going to be the effect in 2018 once all of these changes shift on in. One of the biggest changes that we saw, situation that we saw this past week in the office, is if you're paying alimony, you don't get to deduct it anymore. Well, that's pretty significant, because the individual that we were talking to this past week pays alimony of a couple $1,000s a month, which is $24,000 a year. That's a pretty big deduction, right? Combined with the fact that he's having to pay the alimony out of his retirement account. So at the very least, he's having to report the distributions out of his retirement account, but then he gets to write the alimony off. So it kind of washes. Under the new rules, it doesn't wash, because alimony loses its deductibility. So alimony is no longer deductible to the giver and taxable to the receiver. It is a big shift. So at the end of the day, you're going to want to figure out how to address that pretty significant change. And the reality is one option, and we talked a little bit about this with this individual this past week, is, well, wait a minute. If she's no longer having to report this as taxes and take a cut, because obviously if she has to report it on her tax return and pay taxes on it, then she doesn't get all of the alimony that you're paying her. Maybe y'all can kind of work out a deal where you're paying her less, and ultimately then both of you are in the same position. That gets a little tricky, of course, because alimony sometimes, often is court ordered. So you don't want to just do that on your own without making sure that you're doing it through the proper legal channels. That would not be a good thing. The other one we saw, and we've talked a little bit about it on the program, I think we did this 2 or 3 weeks ago, is charitable giving. And the other example, these folks were very charitable minded to their church, and that was pretty much the only thing that they sort of did in terms of their itemized deductions. They didn't have a mortgage interest, or didn't have a lot in real estate taxes. So for them, the higher standard deduction would ultimately, and the loss of the personal exemption would certainly put them in a position where their taxable income was actually going to go up. And certainly the lower tax rates would keep their total tax bill lower. But the point is that they were not going to be getting as big of a benefit with these tax cuts. So one of the things that we talked with them at length about was doing a qualified charitable distribution, which was available to them because they were over 70 and a half. If you're over 70 and a half, you've got to take a required minimum distribution. You can actually take a portion of that required minimum distribution and send it directly as a check made payable to that charity. Have that come to you, and if you want to hand deliver it, then that's certainly an option. But the check's got to be made directly to the charity, directly out of your retirement account. And then when you report it on your tax return, then you have to put the gross amount in, and then the taxable amount that you would actually report is the difference of that charitable contribution. And then you have to mark on your return the initials QCD. That's how you kind of report that, because the retirement account will not, the IRA custodian won't report that to the IRS. They're just going to report the gross amount of the distribution. So what you need to do on that is to make sure that you're making a record of it on your tax return, because if you just throw the numbers into the computer, then it's going to come back still with the total gross amount that you took out of your IRA. So make sure that you distinguish between the gross amount and the actual tax amount, subtracting out that charitable contribution. You've also got to put the initials QCD down on the tax return itself in order to show that that's really the strategy that you're using. So a couple of different scenarios where there was some significant planning opportunities for that you would want to do for 2018. So we really encourage folks that when they get their tax return done, to not just throw it in a file cabinet, but make sure. I mean, these are big tax changes, and the biggest ones that we've seen in a generation. At the end of the day, we certainly have seen other tax changes, but they were really kind of on the margins. When you start making wholesale changes in terms of eliminating personal exemptions and going to a much higher standard deduction, that's a pretty significant shift, and you need to make sure that you're not affected by that. And we've got one other that I want to share with you as well. So here we are. We're probably about a week into looking at tax returns, and we got 3 different scenarios. We'll talk about the third one after the break, where the game plan has kind of changed, and you need to plan and account for that from a tax perspective. So we'll hit that a little bit more when we get back here on the program, Dollars and Cents with Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA.
This is Bud Hettinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. We've shifted gears in the back half of the program to talk a little bit about some early tax results and the importance of looking at your tax return to make sure that you are ahead of the game when it comes to planning in 2018 the effect of what these big tax changes are going to be on you. For most people, not going to make that big of a difference. If you're taking a standard deduction, then it probably and you've got a paycheck and, just normal stuff, then it's probably not going to really have any impact whatsoever. But if you, other than to lower your taxes, by the way, because the standard deduction went up and the tax rates went down, so that'll produce a lower tax bill for you. But if you've got anything sort of that isn't of that plain vanilla, then you need to be thinking about what to do. And before the break, we talked about two scenarios. I mean, we're 1 week in to looking at tax returns. I haven't really looked at a whole lot of them, and I've got 3 examples to share with you this morning of things, of situations where you've got to adjust the approach and what you're doing. First scenario involved someone paying alimony. Okay, no longer going to be a deduction to him. That's a pretty significant hit because he's taking money out of his retirement account to fund his living, which includes paying the ex-wife. He used to be able to have that a deduction. Now he doesn't. That's pretty significant. The other example is someone that was giving a lot to charity, but it was the amount that they were giving was around $22,000 or $23,000. Well, if the standard deduction is going to go to $26,600, then they're going to lose the ability to take a direct write-off on those charitable contributions, which means the importance of doing a qualified charitable distribution as part of their required minimum distribution is pretty important, because then they get to write off that income directly on the front page in terms of the amount that they report on their income. And then the third example is someone that's taking advantage of the foreign income exclusion. They're working overseas, and when they work overseas, then you can exclude that income from taxes. But you can also have the taxes that you paid be a deduction on your taxes. Now that deduction is capped at $10,000. That's where the $10,000 cap comes in on state and local and real estate and sales tax. Remember, for 2018, the sum total of those cannot exceed $10,000. If it does, you're capped at $10,000. In the case of this individual, he was making, let's just use some rough numbers, $100,000, and he was paying $25,000 of tax to the country that he was making this money in. Now, he doesn't have to pay U.S. tax on that income because of the foreign income exclusion, but he was able to take the taxes that he paid to the foreign country and use that as a deduction so that he was able to itemize his expenses and then able to itemize that to offset other income that he had going on here in the States. The reality is that he's not able to deduct $25,000 on that. He's only able to deduct $10,000 now. So that's a difference. And now for him, where he's never really had to worry about quarterlies or anything like that, he now is having to worry about whether to make quarterly tax payments in the year 2018. So just be aware. I mean, yeah, if you're plain vanilla and standard deduction and W-2 and Social Security and stuff like that, yeah, okay. But it still makes a lot of sense for folks to look at and determine whether these massive changes for 2018 are in fact going to be able to whether you need to plan now to address what's going on with these tax changes, because they're pretty extensive. And if you've got anything, well, I guess those really aren't necessarily out of the ordinary, right? You had one guy paying alimony, you had a couple giving charitable contributions to their church, and then the other one working overseas. I mean, I guess not everybody does that, but certainly a lot of people would find that they might fall into one of those categories. So anyway, bottom line, take a look at that 2017 return when it's done and really start to run the analysis as to, okay, what does this look like in 18 and what do I need to do differently or plan differently based upon the changes that are happening. So on the tax side of things, the tax withholding tables are just beginning to get adjusted. So folks are just beginning to see some adjustments in their paychecks in terms of their take-home pay. One of the things that you should consider is if you are having tax withheld, if you are retired and you are having tax withheld on things like Social Security or maybe your retirement income, and if you want to get a little bit of a pay increase, and of course, why not? Then you may want to look at adjusting the tax withholding that you are doing as well, because that doesn't adjust automatically. If you're working, then those tax withholding tables are going to adjust automatically to reflect the lower tax rates that exist for 2018 and beyond. So that'll happen automatically based upon the withholding tables that your employer has to follow when they're giving you your paycheck. But when you're retired, those tax withholding numbers don't automatically change. You have to make the step or make the effort to actually change the number. So I would encourage you, if you're withholding at 25%, to potentially look at shifting that to the new 22% rate. And then therein lies, you wind up getting an extra 3% of spending money. And you've got to do that. You can't, you can't assume that won't happen automatically. Okay. The tax withholding that you have on things like retirement accounts or Social Security, that's a hard election that you, that you make. But if you're doing 25, the new tax rate is 22. So why wouldn't you lower that to 22? If you're doing 15%, the new tax rate is 12%. So why wouldn't you lower that to 12%? Now, obviously, if you're owing money on the taxes, you want to keep those rates the same. But if you're getting a refund, your refund is only going to be bigger a year from now. So adjust those tax withholding amounts on your retirement and on your Social Security, because effectively that 25% bracket has slid down to 22%, and then the 15% has slid down to 12%. And for that matter, the 28% has gone down to 24%, and then the 33%, most of it has gone down to 24%. A portion of it went down to 32%, and then the 35% went down to 32%. The 39.6% went down to a combination of the 35% and the 37%. So you get the idea that all of these different tax numbers, these tax tables, all of the numbers shifted down by 2 or 3 points. So certainly important to kind of remember that. There's no sense sending the IRS extra money and waiting a year before you get that money back. So definitely look at potentially making that adjustment. Anyway, we are getting close to wrapping up here. We will see how the markets do this week. Certainly last week was pretty volatile. We spent a lot of time at the beginning of part of the show talking about that and some of the reasons behind that. Bottom line is volatility is a normal part of the market. History strongly suggests that what we saw this past week is just a normal part of the market and is not something that spells the demise of the economy. Obviously, stay tuned on that, but we're confident that the underlying economic fundamentals have not changed in a week and a half, and so ultimately we'll see a point in time where the markets get a little less fear-based and a little bit more focused on the simple fundamentals that corporate earnings are growing by 14%. Folks, that's a big number, and one that says that the markets are in pretty good health overall. We will wrap it up. We'll be back next week, of course, but we will be wrapping up here for this week. You've been listening to Dollars and Cents here on 540 AM News Radio 102.5 WFLA. This is Joel Garris, Nelson Financial Planning. Have a great Sunday.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.